So how can you explain this? Well, because there's something bigger going on. There'll be a point to take some profits on a trading basis. Not that the move is over, okay. Gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not.
Silver blasting past $50? Gold soaring to $8,000? Maybe even higher? Michael Oliver says this isn't fantasy. It's exactly what history tells us could happen next. Gold has already made 2 8-fold moves in the last 50 years, and we may be on the verge of the third. Silver, too, could be set for a surge that leaves latecomers chasing like they're grabbing a bar of soap. This isn't just another rally. It's shaping up to be one of the most dramatic moments in financial history. Let's hear exactly what Michael Oliver has to say.
Well, we've had the inflation in the sense that the money growth continues. In fact, they're accelerating. The M2 money supply is making new highs now after a pause. That's an ongoing thing. That's why gold isn't $35, it's $3,500, okay? It's not because of any one single event or commodity inflation. And then, so the inflation really is always there. And that's why gold just keeps, over a period of time, it swings up and down versus that metric, but it's upward, just like the decay in the money units. But in the case of commodities, they don't explain. We showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so it will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because they could go way beyond it, gold has had a couple 8-fold moves. 1976 low to the 1980 high, 8-fold gain. 2001 lows, 2011 highs, 8-fold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000, you would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. and it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know. Well, for about 100 years now, we've had the phenomenon of governments excessively pushing the pedal and using money as their tool of survival. Okay. And in the process of decaying the real buying power of their money units, euros, yens, dollars, whatever, such that, what I mean, decaying the value of money. When your granddad built a house, it cost him $4,500. Now it's $450,000. Okay. That's an example of degradation of money over, a span of 100 years. It's created boom bust cycles. We've seen them. We've seen monetary excess, and then stock market booms, and then stock market peaks and goes down regardless of whether the Fed cuts rates to try to defend it. It goes down anyway. And you get these boom bust cycles created by monetary excessive flows, lower interest rates than reality would have them. Various monetary policies like QE, which they engaged back in 2008, which is now in their quiver, okay? You break the stock market in a few of the, especially certain arenas that I've been mentioning, including, by the way, the banks look very vulnerable technically, especially as we get into next month. All these events could cause the Fed to go berserk. The question is, will this game, this boom bust cycle game where they come in, they try to put the fire out by printing a lot more money, buying assets, cutting interest rates below any reality point, will that work again? We argue no, this time it won't. This time the boom bust will end in something more global and more painful to the average guy than 2008, for example, or the dot-com collapse. This time it's going to be more broadly felt. First off, we have the biggest stock bubble in U.S. history in terms of duration of years upside, the multiple gains in the price of the stock market. NASDAQ 100 went up like 20-fold from its 2009 low over a 15-year period plus, and S&P went up over 10-fold. There's no bull market in history that matches those dimensions. And when you look at money supply or you look at Fed funds rates, you can say, oh, now I understand why. They printed it higher. Okay. When that breaks, real world consequences occur. This time, I think they'll be so severe and also global, although we're a prime bubble. Some areas of the world aren't. China, for example, does not have a bubble situation. They may go down with us, but they don't have a bubble. But it will cause real world in the street consequences where certain things that we all take for granted, but really have only been around this century, one very long human lifetime, such as central banks controlling what money is. Why should you have a government monopoly over the most essential commodity of human interaction? Money. Okay? It's as if government controlled the price of corn, determined how much is going to be produced each year and what its price is. Well, we would call that socialism, right? Okay? Which it, would be. Well, what controlling the most essential commodity in human interaction, a money unit, is even more manipulative and controlling and less free market than any action they've done. But when that process proves that it doesn't work and proves it in a way that's painful to too many people, then you have doubt. And not just among the average guy who's hurting, but academicians who look at these institutions and say, hey, this hasn't been working. It's just been this recurring process. Or like Jamie Dimon made a point, a month or so ago about the bond market situation. It's this constant process of the degradation in government debt in relation to its ability to, raise the money, et cetera, that it can't go on forever. This time it's going to be different. And we think he's right. I think it's going to be true. You're going to have a crisis that isn't just print awayable this time. It will cause doubt and change in institutions. My bet is you won't have a Federal Reserve in a year or so. If events get real dark economically, you may not have income taxes. Why? Because it's simply dysfunctioning. Public can't pay it. And the IRS doesn't function in terms of the percent of revenue it's supposed to bring in. So, they go to sales tax or something. But all these kind of things that we think as norms could go out the window. And the same is true with the monetary metals. This time we think when they go up, they're likely to stay up, meaning become institutionalized again here, there, this country, that country, as money.
Michael Oliver just laid it out. Gold and silver could be on the edge of a historic breakout, one that rewrites the rules of money and markets. The only question is, will you be ready when it happens? If you found this insight valuable, make sure to like this video, subscribe to the channel, and tap the bell icon so you never miss the big moves ahead.